What if I told you the government actually wants you to pay less in taxes? It sounds wild, but the wealthiest people know it's true. Most people see taxes as a fixed cost, but the ultra-rich see the tax code as a game of incentives. The government spells out exactly what it wants you to do. Invest, provide housing, save for retirement, and rewards you with tax breaks if you play along. These are legal, IRS-approved strategies anyone can use, but most people don't know about them. In this video, I'll break down the 3 biggest legal loopholes the wealthy use year after year. Let's dive into the first, and maybe the most accessible loophole. The first strategy is supercharging your tax-advantaged accounts. The wealthy don't just dabble in 401ks or IRAs, they max out every account available, knowing every tax-sheltered dollar compounds faster. For employees, that means contributing the legal maximum to a 401k every year, instantly lowering taxable income. If you're self-employed or have a side hustle, the options get even better. SEP IRAs and solo 401ks let you shelter tens of thousands more. For example, a SEP IRA allows up to 25% of your net self-employment income, up to $69,000 in 2024. Solo 401ks let you contribute as both employee and employer, reaching that same high limit with more flexibility. But the real secret weapon? The Health Savings Account, or HSA. The HSA is the only account with a triple tax advantage: tax-deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses. The wealthy use HSAs as stealth retirement accounts, investing the funds, letting them grow tax-free, and saving receipts to reimburse themselves decades later. Even if you don't have enough medical expenses after age 65, you can withdraw for any reason. Just pay ordinary income tax like a traditional IRA. The key is stacking these accounts. Max out your 401k, use a SEP or solo 401k for side income, and treat your HSA as a long-term investment vehicle. The government created these accounts to encourage saving. The wealthy simply take full advantage. Anyone with a high-deductible health plan can open an HSA, and anyone with a side hustle can use a SEP or solo 401k. Most people ignore these tools, but the wealthy use them to legally minimize taxes and maximize growth. The first step to thinking like a millionaire? Learn the rules, contribute as much as you can, and let compounding and the tax code work for you. This isn't about getting rich quick. It's about consistent, disciplined use of the incentives the government provides. Every dollar you shelter is a win in the long game of building wealth. The power of tax-free compounding is on another level. That's the first major secret: supercharge your accounts and let the government's incentives work for you. Now let's look at how the wealthy turn generosity into a tax advantage. On to loophole number 2. The second loophole is all about giving smarter, not just giving more. Most people donate cash to charity and get a small deduction. The wealthy donate appreciated assets like stocks or real estate instead. Here's why. If you donate stock that's grown in value, you get a deduction for the full market value and avoid paying capital gains tax entirely. The charity sells the stock tax-free, and you both win. This works for stocks, real estate, crypto, anything that's appreciated. The ultra-wealthy often use donor-advised funds or DAFs to make this even more powerful. A DAF is like a charitable savings account. Donate assets, get the full deduction now, and decide later which charities get the money. The assets can even grow tax-free inside the DAF until you're ready to give. This lets you bunch donations in high-income years for bigger deductions, then spread out the giving over time. It's a strategic, not emotional approach to philanthropy, maximizing both your impact and your tax savings. You don't need to be a billionaire to use these tools. Many charities accept stock, and you can open a DAF with as little as $5,000. If you're planning to give anyway, donating appreciated assets is a smarter, more efficient way. The wealthy use the rules to give more, save more, and build a lasting legacy. Shift your mindset. Don't just give smart. That's loophole number 2. Now let's talk about the most powerful tax break of all real estate. The third, and arguably most powerful loophole, is in real estate. The government wants you to provide housing, so it offers huge tax breaks to property owners. The biggest is depreciation. You can deduct a portion of your property's value every year, even though you're not actually spending that money. This phantom expense can wipe out your rental income for tax purposes, making your cash flow nearly tax-free. For example, buy a rental property, and you can deduct the building's value over 27.5 years, often enough to offset all your rental profits. Wealthy investors go further with cost segregation, accelerating depreciation on parts of the property for even bigger deductions early on. But what about when you sell? Normally you'd owe capital gains and depreciation recapture taxes. Enter the 1031 exchange, sell one property, roll the proceeds into another, and defer all those taxes. You can repeat this process, trading up to bigger properties and deferring taxes indefinitely. The ultimate move? Hold until you die, and your heirs inherit the property at a stepped-up basis, wiping out all those deferred taxes. This is how generational wealth is built: tax-free cash flow, tax deferral through 1031 exchanges, and final forgiveness with the stepped-up basis. It's all legal, written in the tax code, but it takes knowledge and planning to execute. Real estate isn't passive, but the tax benefits are in a league of their own. The government's incentives for providing housing are so strong, they can create fortunes. That's the third loophole: use depreciation and 1031 exchanges to build wealth while paying shockingly little in taxes. So there you have it, the three biggest tax loopholes the wealthy use to legally shrink their tax bills and accelerate their wealth. Supercharged accounts, smart charitable giving, and real estate's phantom expense. Each is powerful alone, but together, they're a tax-efficient wealth-building machine. The real secret isn't just the tactics, it's the mindset. Stop seeing taxes as a punishment. See the tax code as a roadmap of incentives. Align your strategy with what the government wants. Save, give, provide housing. And you'll keep more of your money working for you. You don't have to be rich to start. Learn, take action, and let the incentives work for you. If you want more simple, actionable financial tips, subscribe and hit the bell. Thanks for watching. See you in the next one.